Here we're going to take a look at filling out for 2021 a Schedule E and a couple of the forms that might go with it. So I'm just going to make up numbers as we go along. James and Kate Smith. 2, 3, 4, 5, 6, 7, 8, 9. Okay. Did you make, letter A, did you make any payments in 2021 that would require you to file Form 1099? That means, did we pay any individual, not a corporation, but an individual, more than $600 for something like maybe repairs or mowing the grass or whatever? Okay? If the answer is yes, you check the yes box, and that means that by January 31st, you have to have given that person a 1099 that they will file with their taxes. You don't have to take any payroll taxes or anything out of them, but you have to give them a 1099, and a copy of that goes to the IRS. If you have no one individual that you gave more than $600 to, then you can click on no, and you can ignore question B then. And we need the physical address of the property that's being rented. Okay. Then down below that, it says type of property. And that comes from this list, this type of property list. They got 8 different codes. So if this is a house that you're renting out, that would be a single-family residence. Multi-family residence would be like apartments, condos that are attached and stuff like that. A vacation rental, like maybe you have a beach condo down at Hilton Head and you're renting that out. Commercial means business. If you have a building in downtown that you rent out for a business to use. Land, if you're renting out land, maybe to a farmer or something like that. Royalties is if you have, like, you wrote a book, songs, something like that, and then every time a book gets sold, you get some royalties. It's kind of like commission sort of thing. Okay? And so, and there's other things as well. So let's say that this is a single family residence. So we're going to put in a 1 because that's the code for single family residence. Over here in question 2, we have to put how many days it was rented out to somebody. So if you rented it out all year, you would put 365 days. Maybe you only rented it 11 months. Okay, maybe it was 333 days, you know, and okay, now and then the personal use days. How many days did you personally use that property? Now, if this was a vacation, short-term rental, beach house down in Hilton Head, then maybe you rented out here and there for long weekends or for a week here and there to strangers, but you yourself use that beach house sometimes. So you have to separate out how many days is it rented out and how many days is it under personal use. Okay? If you're a qualified joint venture, you would check this box, and that has nothing to do with accounting 124, so you can ignore that. Okay? Line 3, how much rents were received? So maybe you received $15,000 for renting this house out. Okay? Maybe you spent $50 on advertising. We'll come back to line 6, which is auto and travel. Cleaning and maintenance, maybe you spent $100 on that. Commissions that you had to pay to somebody. Insurance, usually if someone is paying rent for the building has to be insured by the owner. So that insures the building for things like if it gets hit by lightning or a hurricane or something like that. It's not the renter that pays for insurance on the house. It's usually yourself, and so maybe that's $1,200. Okay? Legal and other professional fees. So this is like accountants and lawyers. Okay? So especially if you have a lawyer that helps you write up the contracts and stuff like that between you and the renters, then you might have something there as well. If you use an accountant to do the bookwork, etc. Management fees. If James and Kate help manage the property themselves, they go over there and deal if there's a problem or something. Or maybe they pay a property management company and they pay certain monthly fees, and the property manager has to go and deal with the problems. Okay? Mortgage interest, if James and Kate have a mortgage with a bank and they're having to make payments on the building, and then the part of the payments that's interest, that would go here in line 12. Any other interest on credit cards maybe, that the landlords use for, going to Lowe's and stuff. Repairs, whatever the total cost of repairs. So there's $845. Let's pretend that they spent on repairs on the building. Supplies, if the landlord is providing any kind of supplies. Taxes, that will generally mean real estate property taxes, and generally, again, the owner is the one who has to pay insurance, property taxes on the building, not the renter. Okay, utilities. Now, sometimes the owner will pay for the utilities and then just charge a flat amount every month to the renters for utilities, but the owner actually takes care of it. Sometimes the owners want to do that because they want to make sure that the utilities are not ending up being shut down because somebody didn't pay their utilities. Other landlords say, no, you're the renter, you have to get utilities in your own name, and if it's shut off, it's shut off. That's up to you. Okay? So, that just depends from one landlord to another. If you have paid any utilities, then you would mark that in. Okay? Depreciation, we'll talk about that in a minute. And anything else, any other kind of expenses, you would list on this dotted line and put the total on line 19. So let's go back to auto and travel, line 6. And it says see instructions. Well, again, just like with self-employment, you can either do the actual, which you're going to add up your gas, your oil, your repairs for the vehicle, etc., calculate out depreciation on the auto, or you can do the standard mileage method. So, and generally, as we learned before, the standard mileage method will work out better. So let's say that James and Kate have 500 miles for the year that they put on the vehicle. And so we would take 500 miles times for 2021, it's 56 cents a mile, so 0.56. And that's $280. So we would have $280 under the auto and travel if we use standard mileage. The other thing is depreciation. So we have to look up depreciation, and again, we can go back to our depreciation module, and remember we have real property tables, table 7.4, and in this case it is a residential, people live in there, real property, okay, and so that we're renting out, and so that is going to be a 27.5 year. Let's say we bought it in March of 2015, okay, so 2015 would have been the first recovery year. Then we have 2016, 17, 18, 19, 20, and 21. So that's 6 other years, so 6 more recovery years. So we're going to be in this second line, recovery year 2 through recovery year 18. And we go over to the third month of March, that's 3.636. So let's say we paid $100,000 for the house. We would take 100,000 times 0.03636. And that's $3,636. Okay, so we're going to go to Form 4562. That would be under line 17, 36. That's our old depreciation. Now this is assuming you don't have any equipment. Now maybe you purchased that James and Kate had to purchase a new refrigerator for the place. Okay, and let's say that cost $1,000. Okay, and so a refrigerator would be a 7-year property. Convention is half year, and makers. Okay, so we need to figure out how much is that. Well, we just bought it this year. Remember, section B is for assets placed in service during 2021. On line 17, we put the old because that was placed in service back in 2015. So this new refrigerator is, if you look up in your depreciation for personal property tables, you would see the first recovery year is 14.29%. So I'm going to take $1,000 times 0.1429, and that's $143. Okay, now this election to expense, this section 179, part 1 up here, you cannot use that for a rental house, rental, anything, okay, cannot be used. So you have to leave that blank, and we already said that we don't do part 2, so we would just have the James and Kate Smith and 789, and under the business activity you can put Schedule E rental, okay? And okay, we're going to total that up. We got 36 and 143, 3779. We'll pretend that all the other appliances that